All right. This is a video about a file I probably spend a little too much time on. I first made this file, it must have been more than 10 years ago. And this is where I collect all the stock data and just kind of compare different stock returns and volatilities to the S&P 500. Now, after Finance.yahoo kind of changed things, I updated this file a lot, and I want to show you how to use this file and then how to read things in. So I'll give you a little bit of a general introduction. And then I think the interesting theoretical aspect of this is looking at returns on stocks, evaluating costs of capital and the equity market risk premium issues, and some very fundamental questions about finance and economics, and a little philosophy. And then we'll show you how to add companies, and we'll go through this URL and how to modify the URL and split it up, and then how to use the index function to read all the different companies. So you can, sorry about the ding there, so you can add the companies and discuss this issue with dates, because the real key here is to get as long-term analysis as you can and take a kind of long-term view on things. Then I'm going to show you how to read the stocks, do a little technical work, and discuss this issue business with if you're going to use this wonderful kind of method, you have to adjust the VBA and put a reference in, okay? Don't worry about what I said. So I've collected some stocks. Oops, ding again, excuse me for that. And then, here's the way it works. I adjusted this, so if we look at the Standard & Poor's 500, we can get a history, and the beta better be 1, and we have the volatility. And if you invested in the S&P 500 in 1950, you would have gotten a 7.36% IRR, compound return, which means your €1 or ringgit or dollar would have become $140. And if you would have 1,000 USD back in 1950, you would have got 140,000 today. Okay. It's a pretty good return. But this return has inflation in different periods and everything else in it. I've changed this so we can just put years instead of dates. So if you want to see what kind of return you would have made since 1967, I'm looking at this, it would be 6.69. If we go maybe to 87, now there's some inflation, we have to take some inflation out, we would get 7% again, and maybe we'll go to 95, and we get still about 7, a little bit 7 plus. Now, the economy, most economies have not grown, and this, I guess we should use the U.S. economy. It hasn't grown on a nominal basis at 6 or 7%, but the stocks have grown then. Now, if you make a proposition, the following proposition, you say, well, stocks, the increase in stocks has to be directly related to the increase in profits, the nominal increase in profits, or if you could take the real returns, it should be the real increase in profits. Now, if the stocks have gone up by 7%, and let's say the economy's gone up by 3%, then there's a big increase. There's a big premium, and the corporate profits are more and more of the economy. I suppose we should look at that on a macroeconomic basis. Now, if you learn about equity market risk premiums in finance, they tell you that you need about a 5% premium above the risk-free rate, which is way faster than the growth rate in the economy, But that in turn means that the owners of corporations will always grow in wealth compared to the rest of the economy. There's a fundamental dilemma. I don't know if I mentioned it before, but that's cost of capital. This business of earning a premium, uh, earning a premium relative to the growth rate in the economy has a big implication, and it's probably been true too. And the question is, what's the real equity premium that you need, I guess? All right, and we can then, but the big deal is you can just look at these over time, and then you can compare volatility. So let's take General Electric. Now, the way this works is you just put a stock in, and it goes back to the first date it has the stock. And this finance.yahoo is wonderful because this is the adjusted. This is adjusted for dividends, reinvesting dividends, and also stock splits and all that. So there's a beta of 1.18. That has a volatility of about 24%. And you can kind of see, well, let's go later and see if the beta stays the same and the volatility doesn't change too much, okay? And then we go to some GAFM. So we can go to Apple, Google, Amazon, Facebook, Microsoft, Facebook or something. I don't know. Most people know the story of this one, I guess. It says it's a beta of less than 1, but of higher volatility. I think the volatility is, and you would have made an annual return of 39%, which is enormous. Let's look at Apple, just to understand just what a rate of return really means. Now, Apple, with this enormous increase, you invest here and you get 300, that rate of return is 16%. That enormous increase. Now, of course, if we go to kind of when, I don't know, they started making iPhones and all that stuff, then you get a 35% return. If you make a 35% return over a period of 17 years, your 1 ringgit becomes 140 ringgits. Making that kind of rate of return is so hard, and it's so unbelievable, and it makes people so rich. If you can find it, and so when people say, "Oh, in Africa, I need a 20% return," or more than 20%, you just understand what that really means to make those sorts of returns. That's kind of one of the ideas I'm trying to show you. It's hard to find this. Not that, oh my gosh, if you started in 2005, you'd make this, and then we had 25% return, and then we can look at some companies that didn't fare so well, obviously, or we can look at Samsung, perhaps. Okay, and you just put these companies in, and you can see the volatility, the beta. Beta, you have to be so careful with with non-U.S. stocks because the timing of the market is different. So I don't know. And then we have some telecom companies and some utility companies. Okay, and here's one of the kind of remarkable things about these utility companies. You would have made 11% return starting in 1980. If we started in 2003, maybe after it went down, it wasn't so good, but the returns are still pretty high. The remarkable one is really the kind of old-fashioned, really boring utilities, and I better have a Consolidated Edison here. Okay, and that one, you just make these enormous rates of return, kind of given the virtually no risk of the company, and you can look at different periods and see what happened in kind of different periods and see there's a very low volatility and a very low beta. Okay, that's all the kind of stuff. You can look at the R-squareds and all that stuff. All right, that's enough. That's enough of a little bit of an overview. If you want to add another stock, let's say I'm going to go and add a caterpillar. I think that's there. I hope. Cat. I can't spell that. And then let's add Ecolab, okay? And ECL, all right? And so all you do is you just go and plug in the ticker. All right. Now, when you do this, it should have increased the count. Okay. All right. I think it did. And then you can just, if we read one stock, all right, we have to then, I suppose, go to the list. All right. And then we, excuse me, it takes a second here. So then you can just press on this thing that says read one stock. It might, I forgot to press the initialize. Oh, it worked. Okay. And it goes back to 1962. Shift Control Z takes you back to this. All right. And then you can also, here is the kind of night. Excuse me. We can clear all of the sheets. So now we kind of just added a sheet. You don't have to do it at this anymore, by the way, but I'm just kind of showing you how fast. So right now, and this clear sheets is just a little bit of a macro, and the big trick with clearing the sheets is to start at the back and go step -1. That's the big trick here. And then you can read all the stocks. Now, when you read all the stocks, notice, right, the reason I cleared it out, I should have shown you that it deleted all the sheets. You'll have to believe me. But you notice how fast it's kind of going. Okay? And it's reading all of these things in. Now, and I used to do this with workbooks.open. It took longer. I'm going to wait. So it just read in all of the stocks. Let's see what I have on the Caterpillar. So you click on this, and as usual, it goes to the very first date, ends at the last date, and you can see the return you made over the whole period, and you can see the return you would have made in different kind of periods. And I think that's enough. So I have some, let me see, some beer companies, and I have some energy companies. Here's Chesapeake Energy, this big shale gas producer. You can kind of see what's happened there. I guess you would have made a return, but it's got a much, much higher volatility, even though the beta is about the same. And you can argue what's the kind of right cost of capital for that. Now, let's just finish this off. To finish this discussion, I want to show you when you, first of all, it's a good idea to press this thing that gets this cookie and crumb, whatever this is. This is this stuff that you have to put at the end of the file, and I've seen sometimes if you get it wrong. Now, the other thing you do is when you use this thing, and when you use any of this thing called the web request and win HTTP request and all of that stuff, and then you go down here and set web request to win HTTP web request, and you get the stuff, you have to go to tools and references, and you have to make sure that this thing is open or is connected. And then let's just look at what the code is to read one stock. I've done this a little bit before, but I think it's worth doing again. Okay, so we get the URL. That's that long URL, and put all the stuff in the URL. Then what you should do is calculate this sheet that has all the stock prices, and then you just get the data. You put this data into something called response text, which is this enormous text, And then you take this and put it in a file. Now, what I did here is to say, let's add a sheet, and then let's name it the symbol. Now, if there's an error because you've already named the symbol, then go and delete the sheet here. Otherwise, skip the delete, and go around it, and then go to that sheet that was either made or not made, and then select all the cells in it, clear the cells, and then do the key thing, which is to take this little thing where we took this web request and we split it into different rows. Okay, and it found out what the maximum row is. This split command seems to be really good at this stuff. And then you put it in a little matrix. The reason you need to put it in a matrix is a range has if you use this range and assign this range to the matrix, it works really fast. That's what makes the whole thing work so fast. And then you just split it up with a text to columns. Once you've done that, you go back and you just go around the loop like we always do. So you just go around it and you use the index and just change the index key and just put this one that says run stock, which is this one down here, and then you calculate it, and then you've got them all read in. And that's it. And I think that's it for the video. Now, the only other thing to say is that this, I couldn't end that fast. This is going to be in the stock price page up here. So I split the getting the data from just the regular data from the internet, and I put a separate thing for stock prices. So I'm going to put this file there, and this particular file is named retrieve stock prices all. I can update this easily. I think you can see how you can update this if you want. Now, there's one other thing I just want to show you. I'm saving this file, and I'm going to close it. Okay, and what this file doesn't do is what I'm going to do in this comprehensive stock analysis that I've introduced to you a couple of times before, but I want you to kind of, if you're interested, see the difference. Okay, and now right now I have to do a little bit of work on this. But the big difference is that you can look at different indices and different stocks at the same time, do a little more statistical analysis, and also compare the stock prices to the commodity prices, and sometimes get stocks that might not be reported in Yahoo. You can go and get them from Google Finance. Particularly maybe stocks in Asia and some other places. So this compares indices, and then finally we'll adjust the stocks for different currencies. So this is a little more advanced. It's got some more stuff in it. A lot of the fundamental ideas are the same, but we need to use different reading techniques from the different files. So again, it'll be somewhat similar. You'll take one stock or one indice and compare them to other indices. Okay, using a lot of the same ideas. Now, this file will also be in the same place on the internet, and if you want to go to the Google Drive, now I'm really going to finally finish. You go to chapter 1, and then under chapter 1 you go to stock prices, and you can get kind of the various stock price things, including this comprehensive analysis and the stuff that I've just been revising and finishing up now. All right, so that's that.